This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live as always from the CNBC-TV18 Motilal Oswal studios. It's a fresh new week, Monday morning, a rainy morning, as we've gotten used to over the last many weeks. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Morning.
Good morning. So it's a brand new week, but lots to react to this morning, right? There's ICICI Bank, there's Kotak Mahindra Bank, there's Reliance, and there's a big US Fed meeting coming up in the next few days as well. So we have our hands full.
We have a
As
hands
we
full,
always have.
I thought we were going to start with Barbie, Oppenheimer. I mean, who did what? Nothing?
I watched Oppenheimer this weekend.
I did too.
Both of you loved it, I think.
And what do you think of it?
I thought it was great. But I'm a big Christopher Nolan fan. I thought it was too long, 3 hours, but gripping. I mean, fantastic storytelling.
I don't know, unpopular opinion, but I think I was a bit underwhelmed. There were a couple of scenes which were good, the main scene, but apart from that, I could have easily just caught it on Netflix or something.
So I've got an excuse to skip it.
I'm a big Nolan fan as well. I think there was so much hype about this movie that eventually when you go in there, it was a bit underwhelming and very, very long.
I watched the 7 a.m. movie, Sonia. So I think that's the earliest I've gone into a theatre. I watched the Mission Impossible as well. But that is, I mean, anyway.
So I watched the 11:30 in the night movie, by the way.
Night.
So I was asleep by the time the climax came through. I was asleep.
Nigel, don't miss it, by the way.
Yeah, I'll give it a go. And you know, our producer as well is telling us, Anurag, he's saying he went for it at 12 midnight. So he was, in that sense, he was a little earlier on the day.
We'll ask him how he liked the movie as well.
Absolutely. Well, more reviews coming up through the course of the day. But let's quickly tell you what you need to know as we begin another trading session. We kind of begin with earnings once again. And I say again because on Friday morning, we came back and reacted to Infosys earnings in a big way. That tryst with the 20,000 mark on the Nifty could not happen because of Infi. It took the entire tech sector down. But today, this morning, it's a fresh set of earnings. There is Reliance, there is ICICI Bank, and then there is Kotak Bank as well. Actually, it's the Reliance on one side. Numbers are a little mixed, really. It's not seen... I've seen some earnings downgrades and, some kind of hand-wringing about what this may mean for stock performance from here on. A lot of people are pointing to the GDR, which was down about 5.5%. But let me tell you, GDRs, I think they lost real relevance in terms of price signaling, at least, I think, 10, 15 years ago. Very, very thinly traded. Stock, anyway, was down about 3% or so on Friday. So perhaps it is... taking some of the damage, perhaps it kind of priced at it early on. So that is Reliance. In any case, it doesn't help on the upside. Does it hurt in any meaningful way? I don't think so. We can discuss more about Reliance, and we've got a discussion lined up a little later here on the program. On the other side, ICICI Bank and Kotak are interesting as well because ICICI is steady as ever. Actually, spotless performance once again. And ICICI Bank is creating records of sort. We'll talk more about that. Kotak also did well. Especially on the deposit growth front, people were surprised very positively. The niggle really is that both have seen very minor earnings upgrades, if any at all. Actually, I saw some downgrades for Kotak as well. ICICI Bank, people were expecting very strong and they got very strong. So we've seen very minor earnings upgrades. CLSA, for example, has moved up their estimates by less than 1%. So those kinds. And earnings estimates being moved up is basically what causes stocks to move higher or, down on the other side as well. So that's, but it doesn't hurt. That's the point. ICICI and Kotak Bank, perhaps how much can it help on the upside? We'll wait and watch. In global cues, Friday's session in the US market was kind of flattish, so not very much to take away from that. But this week is a big one. You've got the Fed decision. The FOMC is all set to hike by 25 basis points. The decision is on Wednesday. We react to it on Thursday morning. The big question, though, is this the last hike in this tightening cycle? And we'll have to kind of wait and watch for that one. The presser will be important as well. It's a big week for tech earnings in the US as well. So Microsoft and Google report on Tuesday and Meta reports on Wednesday. And this is especially important because it's been a narrow rally which has been broadening out, but this is still a very large FANG tech-led rally out there in the US. Now, let's come back to levels that you need to watch out for. I'm going to put support levels here on the upside. We all kind of know targets, etc. Support for the Nifty comes in first at, and I put this level out on Friday morning as well, 19,620, 19,600 roughly. That's the hourly exponential moving average for the Nifty, the 40. The 20-day comes in below that at about 19,400. 19,372 is the precise exact number. So let's see if it comes to a point where any of these levels are tested. On the bank nifty, the near-term support comes in at 45,630 or so, and there we left off at about 46,075. These are near-term supports for both the nifty and the bank nifty. Many after Friday's big correction, many are saying, well, this is it, and this is the start of a steep decline, etc. From where I'm sitting, how I'm looking at things, it doesn't seem like that. Maybe a bit of a pullback, sideways action after the strong price performance, but doesn't look like we're starting something very large or meaningful on the downside. The GIFT Nifty implied opening up on your screen, it's indicating a lower start. Sonia.
Oh, absolutely. I just want to take some of these points forward because as we know, the market is going to start in the red this morning. All eyes are going to be on ICICI Bank and Kotak Mahindra Bank. But in that context, just a couple of points. Yes, the ICICI Bank numbers are very good. In fact, they're best-in-class numbers, better than what we saw from HDFC Bank as well. But how much of it is already in the price is the question, right? Because ICICI Bank, just look at the numbers. Deposit growth of 18%, asset quality has improved. But the stock has also gone up about 20% since the month of March. And there is a drop in the net interest margin sequentially. So that is a bit of a concern that you have to keep on your radar. So the big question on my mind is, can ICICI Bank re-rate further? Because it's already seen a big up move of around 20-odd%. So that's the big question. On Kotak Mahindra Bank as well, robust loan growth, 17.5% year-on-year. Net interest margins are strong. It's a good stock, but the stock is expensive now. So are these numbers good enough for the stock to see higher valuations? Time will tell. There's also that, overhang about Uday Kotak. So that's something that the street has sort of penciled in the last many weeks and months. So just keep these two stocks on your radar. For Reliance Industries, it's a mixed bag, no two ways about that. The consumer businesses are doing well. The O2C business has, some pressure points. So that is perhaps something that the street could factor in. But if you look at what happened on Friday, there was big buying by domestic institutions. So they bought about 1,290 crores in the cash markets, but the selling from FIs was more than that. So in that context, perhaps today could be another red day where you could have Reliance and Infosys perhaps drag the market a bit, but supported by Kotak Mahindra Bank and ICICI Bank. Now, all eyes on the Fed meeting, as Prashant was also saying, there's a rate hike that's expected. But apart from that, there are important earnings this week. There is Tata Motors and Bajaj Auto tomorrow. On Wednesday, you have a string of earnings from the Nifty. There's Axis Bank, Cipla, Dr. Reddy's, Tech Mahindra and Bajaj Finance. So we have a handful in terms of earnings to react to. But let's see which way it goes from here. There are plenty of other numbers as well that we'll be reacting to. There's PayTM, there's HDFC Live. So we'll talk more about that later.
Well, that's right. Sonia, the bulls, they'll be pinning their hopes on the Nifty Bank because as you said, Reliance Industries, well, it could move sideways, maybe a little bit of a downtick. And you have the IT stocks, well, they could consolidate as well in the near term after the selling that we saw in Friday's trading session. So the bulls, they pin their hopes on the Nifty Bank, courtesy, ICICI Bank's numbers, Kotak Mahindra Bank's numbers as well. The US markets, well, they have been on a bit of a winning streak, but the dollar index is, inching up. It's moved to around 101 odd. That's normally a sign of caution for emerging markets, and we are included in that as well. So it's gained close to around 1.5% just in the last couple of sessions. And we have big, central bank meets this week. We have the Fed, the ECB, as well as the Bank of Japan. The IT index, well, that one is only around 0.5% or nearly around 120 points away from its 20-day MA, which at the index level, that's the first level of support out there. Flows were a little bit disappointing. The FI is sold. And if you look at the FI and the DI numbers together, the institutions were net sellers to the tune of around 700 crores. We were used to, in the month of July itself, on an average, we were seeing 700 crores of inflows. So the swing factor out there is nearly around 1,400 crores. The FI as well, they added some bearish bets as well in the FNO market. And I'll say this is not such a bad thing. So they added some shorts. They added close to around 7,000 short contracts. They unbound some long positions. They continue to remain net long at around 68% odd, but that's come down from nearly around 80% odd, which is good news. You want some shorts in the system. What's telling you that higher levels we could see some supply is the way there were calls that were written. More than 3 lakh call contracts were written in the ratio of 2:1, and two strikes were very active. 19,900 call, 19,800 call. Between them, they added more than a crore shares odd, which brings us to the level. Since we saw writing at higher calls, well, then that 19,900 odd level, that becomes a bit of a resistance on the upside. The PCR has cooled down to around 0.9. We were making this point from around 1.5, 1.6. It's cooled down to around 0.9. Normally, it bottoms out at around 0.7 odd. Getting to the levels, support we get in at around 19,650 to around 19,680. That's the broad range. The gift nifty suggesting that we start off with a cut of around 60 to 70 points, I think so. The last time I checked, 70-point downtick. So importantly, if you're going long, then that 19,650 odd level should hold out. And the Nifty Bank, that'll be the crucial one from the bulls.
Okay, we have plenty to reckon with. So without wasting any time, let's kickstart the show with some equity views coming through. We have Chetan Seth of Nomura, who says the main focus for the markets this week will be on some major policy decision in the US, China and Japan. While the Fed is widely expected to raise rates, he believes Fed Chair Jerome Powell will not have enough reasons to sound even more hawkish than some of his previous comments. He adds that even if the Fed downplays recent disinflationary trends and comes out hawkish, it will likely have a limited, short-lived negative impact on stocks.
Okay, let's get you some money market views here. B. Prashant of ICICI Bank says the dollar recovered after stronger U.S. labor and consumer sentiment data ahead of the FOMC. He says softer inflation prints and dovish pre-policy comments weakened the pound and the Japanese yen, while the Chinese yuan was supported by stronger PBOC fixings. He adds the rupee traded with an appreciation bias backed by strong inflows in equity, and the RBI was seen aggressively protecting appreciation by buying dollar around the 82 levels. He says for this week, FOMC and Bank of Japan meetings will give cues to currencies, and he expects the rupee to trade between 81.9 to 82.4 to a dollar.
All right, that's on the rupee. On the bonds, B. Prasanna says that the global yields consolidated post a sharp rally witnessed over the last couple of weeks, awaiting cues from the upcoming Fed policy. Back home, strong investor demand has kept yields supported. He expects the bond market to remain range-bound within the 10-year benchmark bond yield, trading in a range of 7.05 to 7.15% range.
Well, we have a lot of stock-specific action track for you. Get to that in just a bit from now in our special Top 10 segment. But let's list out the stocks. We're looking at Reliance Industries, ICICI Bank, Kotak Mahindra Bank, RBL Bank, DLF. We also have a few more stocks that we should be looking at. Credit Access, Grameen, they are all stocks that will be reacting to positive news flow. On the flip side, Vedanta, PayTM, IGL, AU Small Finance Bank will be reacting to negative news flow.
Okay, Ed Yardeni is president at Yardeni Research. He's joining us now, as always, to take some questions. Ed, good to have you back on the program. Thanks very much for your time. Prashant, this side. Will the Fed be important on Wednesday with their decision and the commentary, Ed? Because markets have, it just gives you a sense markets perhaps have moved on. Interest rates have gone up 500 basis points, but stocks are flying high. The S&P is about 5% away from all-time highs. So what can the Fed do or say, in your opinion?
Well, I guess the market is saying there's not likely to be any surprises coming from the Fed. Everybody's expecting a 25 basis point hike up to 5.25% to 5.5% for the range on the Fed funds rate. And then the question is whether they'll go again. And everybody will be focusing on the commentary, as you mentioned, and the commentary that we'll get immediately after the meeting on Wednesday is from Fed Chair Jerome Powell. And he's likely to say that they might or might not move again, that they may very well be at a restrictive level, but he's not completely sure of it. So he's going to be very ambiguous. But I think the data is going to show that despite the economy's resilience, inflation is coming down, and that the Fed really has achieved what it wanted to, get to a level that is of the Fed funds rate that's high enough to bring inflation down.
Ed, how are you feeling about a market like India? Do you think the run that we've seen so far could take a bit of a pause? Because the earnings that we're getting are not as impressive as perhaps one would have expected, especially in spaces like technology. Do you think that could be a deterrent for the market? And what's the approach now?
I think it's important to put India in the context of the global economy. And the global economy isn't in a recession, but it's certainly not in a boom. We know that China's economic growth is turning out to be disappointing. We know that Europe didn't fall into a severe recession as a result of their energy crisis last year, but nonetheless, it has been in a modest recession in the fourth quarter of last year and the first quarter of this year. And we've seen the commodity prices haven't really moved up or down. We've seen that oil prices has moved sideways, copper has moved sideways. So I think India is kind of facing the same global situation as all of us are facing. It's not too hot and not too cold. It's somewhere in between, and maybe it's somewhat disappointing relative to expectations that things would be better.
Hi, Mr. Yardeni. Good morning. I'm looking at a Nomura note where they mentioned that Chairman Powell may not have more reason to be hawkish than what he's been in the past. So let's see how that goes. The verdict is split down the middle. We get one hike and then let's see how it goes. But, the other focal point from an India perspective is what's going on with China. And there are some hopes there's going to be a stimulus package that's going to come out there, which could, reignite the Chinese economy. What's your view on that?
I think the Chinese government has a serious problem because they have been stimulating their economy for many years with ample supply of credit. It's created a real estate boom, and now that boom is turning into a bust. And it's not going to be very easy to just, with policies, make that problem go away. It's in many ways, it's a speculative bubble that has burst. And on top of all that, they have a horrible demographic situation. I have often been saying recently that China has become the world's largest nursing home. The demographic situation is pretty dire. It's a very rapidly aging population, and older people just, don't spend as much money. They certainly don't buy additional apartments. And so I think it's going to be hard for the Chinese government to come up with a policy that stimulates. The good news is China's weakness has translated into a falling PPI over there, and that in turn has an impact on the PPI in the United States and probably around the world. So I think China's problems are actually turning out to be a pretty good development for the U.S. in terms of allowing us to have disinflation, falling inflation without a recession, because China's got its domestic problems with a weak economy.
Okay, Ed, we'll leave it there. Thank you so much for joining in, and hope to speak with you once we have the Fed decision and we hear from Fed Chair Powell later this week. That's on Wednesday. Well, it's time for our first quick commercial break here. Our list of top stocks to watch lined up next. Stay with us. Our research team will be with us on the other side. I loved it.
Don't you feel it was like a documentary? Same. No, but I think we took a wrong. And his voice, now that silly, that more and more to sleep.
Blame the blanket, Anurag, not the movie.
Okay, we have many stocks to talk about today. Strong earnings from ICICI, Kotak Mahindra Bank, a mixed bag from Reliance Industries, so plenty to talk about. Let's do one thing. Let's kickstart with Reliance and tell you how the numbers looked. Overall, the numbers were actually a mixed bag. If you look at it, the earnings were strong in the consumer business, but the oil to chemicals business had a bit of, some niggling worries there. Overall, the operational performance was not too bad. The oil and gas business was actually better than what the street was estimating. So that was a good thing, while the consumer-facing businesses were very strong. In fact, the retail business saw a revenue growth of 20%, higher than what the street was estimating. And retail is firing on all cylinders. The company saw 555 new store openings, taking the total count to a little under 19,000. It was a steady quarter from Reliance Jio as well. The subscriber addition was very strong. The average revenue per user went up almost 3% year on year. This was driven by a better subscriber mix and the ramp up of its wireless business. The other thing for Reliance is that the balance sheet is also improving. So the net debt is flat on a quarter-on-quarter basis, adjusted for the JFSL demerger. So the core numbers will be up for you on your screen. Revenue coming in a little lower than what they did same time last year at 2.07 lakh crores. On the EBITDA and margin front, there was an improvement year on year, which is what the street would like. Margins coming in at 18.5% versus 17.3%, while the net profits were down about 11%. Let's quickly put the brokerage views on board. Citi has a buy with a target price of 27.50. JP Morgan has raised their target price to 3,040, so they are one of the most bullish on the street. Morgan Stanley has it at 3,000, while Jefferies has a buy with a target price of 29.35. Of course, standard disclaimer, Reliance Industries is the owner of the channel that you're watching. But Harshvardhan Dole and Balaji Subramaniam of IIFL Securities will be joining in at 9 a.m. to decode the Q1 performance.
Okay, all right, Sonia, thanks very much for that. Well, let's talk about the banking numbers, right? There's Reliance and there is on the other side ICICI Bank and Kotak Bank. Abhishek is here with what he made the numbers and what the street makes of it. Abhishek, morning, over to you.
Morning, Prashant. So to begin with, ICICI Bank's quarterly ROA and SDFC Bank's quarterly ROA, the gap is now 35 basis points, which is the highest ever that I've seen. Records galore at ICICI Bank. The gross NPA ratio and net NPA ratio are one of the lowest in the last 8-9 years. Deposit growth of nearly 18% YOY is perhaps one of the best that you are seeing in the last 9 quarters. And on a sequential basis, the deposit growth was 4.9% for ICICI Bank when compared to 1.6% for SDFC Bank. The unsecured book that continues to grow highest in last 23 quarters now. Its share is about 19.9% of the loans. The restructured book at just 0.37% is perhaps one of the lowest that you are seeing in last 10 quarters. Watch list is the lowest in last 30 quarters, and overseas book also continues to decline, now at just 3% of the overall book. On the flip side, CASA ratio has declined to 43.3%, perhaps the lowest in last 12 quarters, and it is an industry trend that you are seeing CASA ratio decline for all the banks. Risk-weight assets to advances ratio is perhaps one of the highest in last 11 quarters, coming in at 109.3%, and core operating profit growth is at 0.15% on a sequential basis, which is the lowest in last 12 quarters. PNL, both the NI and PAT is a beat on our poll. Kotak Mahindra Bank, what has worked is the fact that deposit growth is pretty strong at 22% YOY, is perhaps the best that you are seeing in last 4 years, and sequentially 6.5% growth is perhaps the best in last 13 quarters. ROA continues to remain at the best that industry is seeing in Q1 FY24 at 2.8%. Net interest margin remains strong at 5.57%. They have declined on a sequential basis, but remains one of the best amongst large banks. Restructured book at just 0.2% is the lowest in last 3 years. Consolidated ROA and ROE are one of the best that you are seeing for Kotak Mahindra Bank. What has not worked is that retail portfolio growth of just 2.2% is on the lower side when you compare to overall loan growth. Subsidiaries performance is weak or soft on a sequential basis. Subsidiaries PAT have declined by 0.4%. Slippages have increased quarter on quarter, seasonal in nature that you are seeing with other banks, and CASA ratio at 49% is the lowest in last 22 quarters. PNL, NI and PAT is a beat on our poll. Back to you.
All right, Abhishek, thanks very much for that. Well, let's also hear out what the management of ICICI Bank had to say after their first quarter earnings in the conference call. Listen in.
The gross NPA additions were 5,318 crore rupees in Q1 2024. Recoveries and upgrades of NPAs, excluding write-offs and sale, were 3,511 crore rupees in Q1 2024. The gross NPAs written off were rupees 1,169 crore rupees in Q1 2024. Going forward, we will continue to operate within our strategic framework while focusing on micro markets and ecosystems. The NIM for this quarter was 4.78 as compared to 4.9 in the previous quarter and 4.01 in Q1 of last year.
Yeah.
Okay, I think we have been saying that the retail deposits rate of increase has been slower than what has been the rate of lending. So the Q1 2024, the sequential decline actually reflects the lagged impact of repricing of deposits, which has been sort of partly offset by increase in loans and investment yields. Secondly, I think as we have been guiding even in the previous calls, so overall decline in NIM was very much in line with our expectations. But broadly, if I look at, I think it will be good to look at the full year FY24 in the context of what we did in FY23.
All right, well, that's about ICICI Bank, but let's focus on Vedanta. The numbers came post-market hours. Hindustan Zinc we got during market hours, so this is the numbers ex the India Zinc business. And that was a bit of a disappointment. The consolidated EBITDA, well, it came in at around 6,400 crores. We were working with a number of close to around 7,000 crores. And margin-wise as well, it was a miss in comparison to our poll. This after Hindustan Zinc's numbers coming in line. Looking at the segmental performance, Zinc International Business, zinc prices were weak, right? One of the weakest metal prices is what we've seen that is on zinc. And that's why international zinc business, well, that got hurt. Oil and gas as well, crude prices did come down. You saw that, that contracted a little bit. While aluminium and power, the contraction was not that much. The other problem is the debt has moved up. It's moved up by close to around $2 billion on a quarter-on-quarter basis because they're paying out dividend in excess of what they're getting from Hindustan Zinc. There's that brand fee as well that they're paying to Vedanta Resources, which isn't so good news. So that debt ballooning up is as well not good, expecting the stock to open up in the red.
All right, expect the stock to open up in the red. That's on Vedanta. But plenty of other stocks. PayTM would be of high interest to viewers. So Abhishek is going to tell us more about that. There's also RBL Bank that he's going to talk about. Abhishek, over to you.
Well, Sonia, to begin with PayTM, sequentially a weak quarter per se. Total income is up about 38.3% YOY and about down 0.02% sequentially. Last year, same quarter, Q1, it was a sequential growth of 9% over year. Contributor profits have grown by almost 80% YOY and about 1.6% sequentially. Last year, same time around, the growth was about 34.5%. Contribution profit margin have expanded both YOY and quarter-on-quarter to about 55.7%. However, on a sequential basis, the net loss has widened to about 358.4 crore when compared to 167.5 crore in this previous quarter. RBL Bank, operationally, it's a strong quarter over there. Net interest margin has declined on a sequential basis but remains elevated at 4.84%. The slippages are at 555 crore. Annualized slippage ratio is perhaps one of the lowest that you are seeing in last 11 quarters. Asset quality has improved. So gross NPA ratio and net NPA ratio X of Q3 FY21, which was the dispensation quarter, is perhaps the best in last 4 years. Return ratios are the best in last 16 quarters. ROA of 1.01% and ROE of 8.4%. RWA or risk in the balance sheet is actually one of the lowest that you are seeing in last 13 quarters as the RWA to advances ratio is at 120.5%. PNL, both in terms of NI and PAT, it's a beat on our poll. Back to you.
Okay, thanks a lot for that, Abhishek. Well, in fact, we'll be joined by the management of RBL Bank at 10 a.m. later today. Well, turning our attention to other couple of numbers, then Sonal joins us to tell us about IGL and DLF. Morning, Sonal.
Good morning, Nigel. Let me start with IGL. It was a volume miss, though operationally the margins expanded on a quarter-on-quarter basis. Revenues down 7.5% quarter-on-quarter. We had EBITDA growing by 38%, margins at 18.8% versus 12.6%. But this compares with a poll of 19.2%. Profits were also up 33%, but slightly lower than the poll. As I said, it was a margin miss, though lower, but it still comes as a negative because volumes have actually declined on a quarter-on-quarter basis to come in at 8.2 SCMD, EBITDA per SCM largely in line at 8.6 rupees. Jefferies has a buy rating on the stock with a target price of 565. They say it's a margin-led beat. However, volumes fell quarter-on-quarter basis and they were 2% lower than what Jefferies was estimating. So this would not go well with the street. So that stock will be in focus. DLF, on the other hand, bookings were flat on a YOY basis. Of course, Q4, that's the last quarter, they saw a substantial rise in bookings. So of course, it's a big decline on a quarter-on-quarter basis. But their balance sheet has improved. Net debt has come in at 57 crore rupees and the FY21 net debt was at 5,200 crore rupees. So there has been a big decline in net debt as well. In FY24, they have a planned launch of 11.2 million square feet, which has a sales potential of around 19,700 crore rupees. An interesting fact update here as well, that the company has re-entered the Mumbai market after Prestige DLF is entering the market as well. This is via an SRA project. They'll be doing it via a JV. So this will be an interesting space to watch as well.
I'm not interested in any more developments here in Mumbai. With the way there are no roads, there are only potholes on the roads. We can do with a little less development and perhaps focusing more on the core infrastructure, whether it's the roads and bridges.
Absolutely.
But you need skyscrapers, right? I mean, island cities always build up. I mean, that's the only option because
Don't we have enough of it already?
It depends on who you ask. So, yeah, well, all right, that's DLF and real estate for you. But let's focus back on financials, right? AU Small Finance Bank reported. Credit Access Grameen also reported numbers. So, Abhishek, work cut out for you.
Prashant, to begin with AU Small Finance Bank, the net interest margin is at 9-quarter low of 5.7% versus 6.1%. The cost of funds is weighing over there. Operating profits have declined by 4.5% quarter-on-quarter. Bank has used a contingent provision of 62 crore, which actually helped the PAT this time around. Slippages have increased quarter-on-quarter to 317 crore versus 191 crore. Annualized slippage ratio of 2.02% versus 1.31% in the previous quarter. Asset quality has deteriorated a bit, and provision coverage ratio has declined sharply to 69% versus 75% in the previous quarter. In terms of our poll, the NI is slightly below our poll. PAT is ahead of our poll. Credit Access Grameen, the asset quality has improved over there due to write-offs that continue to remain over there. Disbursements are down 33.5% YOY. However, AUM growth has remained stable at around 40% YOY and about 3.7% sequentially. The NI growth is pretty strong at 19.2% YOY and about 14.5% sequentially. The net interest margin is at 2 or 3 year high at about 13%. PAT is also strong, growing at 86.3% YOY and about 37.5% sequentially. Back to you.
Okay, thanks a lot, Abhishek. That's AU Small Finance and Credit Access Grameen. We'll talk more about those in a bit. We'll be joined by the managements of Credit Access Grameen and AU Small Finance Bank later on the show. So do stay tuned in for that. That comes up a little before 10 a.m. Here's a quick recap of our top stocks. Stocks with positive news flow. There's Reliance, ICICI Bank, Kotak Mahindra Bank, RBL Bank, DLF and Credit Access Grameen. While stocks with negative news flow, Vedanta, PayTM, IGL and AU Small Finance Bank. But let's also get a quick handle on what's happening in the world of commodities. It's a big week because you have the US Fed policy as well on 25th and 26th. Manisha Gupta is joining in to tell us what's been happening in the world of crude. Manisha, hi, good morning.
Morning, Sonia. Thank you for that. Well, yes, the US Fed meeting concludes on Wednesday. It's going to be a big one. But apart from that, you also have the European Central Bank, Bank of Japan monetary policy meetings also coming in this week. So this is a loaded week in that sense. And we have seen the US dollar index gain ahead of that, which is putting pressure on commodity prices. So the crude oil prices did gain on Friday. We reached the 12-week highs onto this one. From those kind of highs right now. There also is a statement from UAE oil minister saying that they may take further action to support oil markets if the need be. But having said that, it is all going to be about the China introducing targeted stimulus measures. That is what the street is waiting for. Until now, we have seen stimulus measures come in for EV buying and consumer electronics buying as well. It really is about the real estate that markets are awaiting some kind of a liquidity injection coming in. Until then, the pressure in the metal prices also can continue. So if you look at the copper prices, we've seen 3% of decline in the previous week. And most of the metals right now, whether it's copper, zinc, steel, have started on a weaker note.
All right, so thanks very much for that. That's Commodities in Focus. We'll take a very quick break here. We'll be joined by the management of Ashok Leyland to discuss their first quarter performance. Numbers were a beat from Ashok Leyland. So stay tuned for that. More coming up on the other side.
Welcome back. Hope you're having a good morning. Well, looking at the gift nifty, we'll actually start off on the back foot with a cut of around 60 to around 70 points odd. But it's a good time now to get you our first corporate on the show. Ashok Leyland reported a strong performance in the first quarter with net profit and revenue coming in above what the street was working with. It was also a second consecutive quarter of double-digit margin growth. Sonia caught up with the managing director and CEO, Mr. Shenu Agarwal, and started by asking him about the outlook for volume growth for the rest of the year. Let's listen in to what he had to say.
The industry is moving well. We are seeing the growth momentum in Q1. We have seen it. And I think going forward, the growth momentum should continue. Ashok Leyland has been doing better than the industry for many, many quarters. We hope to continue with that momentum.
Okay, when you say continue with that momentum, can you give us some ballpark number? Are you looking at double-digit growth in volume by the end of the year for the industry? And if yes, what would Ashok Leyland's performance be like?
See, our guidance on the industry was 8 to 10% growth in this year over last year for MHCV and about 5 to 6% for LCV. We are still maintaining that guidance right now since Q1 has been little subdued against that guidance because of the pre-buying that happened in Q4. We think the growth momentum would actually increase in the rest of the 3 quarters for the year.
Okay, so Q1 was a bit subdued due to pre-buying that happened in Q4. Got that. So you're holding on to the guidance of 8 to 10% for the MHCV industry for FY24. What about on the margin front? This is the second consecutive quarter that you've done double-digit margins. Is this something that you can hold? Because earlier you had said that you'll achieve double-digit margins by the end of the fiscal, but you've already done it in the first quarter of the year. So what is the outlook for the remainder 3 quarters?
Yeah, that is right. So we were hoping to kind of close the year, whole year with a double-digit margin, and it's very good to see that we have been able to do that in Q1 itself. And that has come because of many factors. I think firstly, our mix has continued to improve. Secondly, we have been able to fetch better prices, and that is on the back of our new products like Avtar and Bada Dost. Also, there has been a very, very focused effort in the company to look at all the costs and reduce our cost wherever possible. So I think on account of all of this, we have been able to register double-digit margins even in Q1. Going forward, definitely we would like to maintain that. Another help that we will get from the margin perspective would be that we think that the commodity prices would continue to ease as we go along in the year. So that would further help us improve our margins.
Okay, so commodity prices will continue to ease and that will help you improve your margins. So are you looking at the 10 to 12% range in terms of margins? Could it be better than that? Because in the preceding 2 quarters, Q1 and Q4, you did about 10 and 11%. So is this the range that you're aiming for?
Yeah, our guidance is still kind of double-digit margins for the whole year. You know, there are a lot of factors that we are watching, but I can assure you that as far as cost is concerned, we are going to continue to put a lot of efforts in cost reduction. Also, as I said, the market should continue to do well in rest of the quarters. Actually, it should do slightly better than what we have seen in Q1. So we are very hopeful that because of all these efforts, we should continue to deliver a strong performance.
Okay, so the market will do better than what you've seen in Q1. That's good to hear. Can you tell me a little bit about the discounting? Because I understand the discounts went down in this quarter, but to what extent? And what is the average discounting level now compared to what it was last year?
Yeah, so I think the industry took a kind of a price hike. Not everyone, but most of the players took a price hike in April, right? So that really helped the industry. I think Ashok Leyland, because of the great acceptance of its products, especially the Avtar range and the Bada Dost range, would continue to have that advantage to increase its price parity in the market. So we would see, of course, it depends on a lot of other factors, how the commodity prices behave, how the competitive play is, how the market grows. But we are very confident that if required, we will be able to take a price hike with not so much of a problem.
Okay, so you can take a price hike and the market will absorb that. The market share of Ashok Leyland has also gone up. It's almost at 32% now, 31.7% to be precise. Do you see a scope of improving market share further? And if yes, by the end of the year, any targets?
Yeah, we already said in our investor meet last month, we already said that we want to continue to increase our market share focus. Last year in MHCV, we increased our market share by 5%. We are very happy that in Q1 also we had a roughly 1.2% increase in our MHCV market share and also 1.6% increase in our small commercial vehicle market share. So yes, that is the intention definitely, that on back of our product acceptance as well as our efforts on the network expansion, we would continue to go for a market share increase.
Okay, any target that you have by the end of FY24?
See, what we said in our investor meet also last month was that our target is to get to 35% market share. From 25 last year, we have already moved to 30 or 30 plus now, and our intention is to move to 35%. Now, of course, that much cannot happen in 1 year now, but I think within the medium term, next 2 to 3 years, our intention is to get to 35% market share in MHCV.
Okay, well, that's Ashok Leyland. Ajay Botke is now joining us for some stock talk. Ajay, good morning. Good to have you with us here. Prashant, this side. You know, the top of the mind question for most who are trading is what to do with these three names: Reliance, ICICI Bank, and Kotak. So very short term, what are your views? These three names.
Yeah, I think the Reliance numbers broadly are in line with market expectations. One point I'd like to highlight is that the Singapore GRMs are back to roughly $7.95 per barrel. This is the highest level since March 23. And the lowest that you saw in last few months was in May 23, when the GRMs had fallen to as low as $0.9 per barrel. So this is the point to be noted insofar as the O2C business is concerned, where the performance for Reliance in the last quarter has been relatively subdued. So there, I think, you know, if you look at some of the details, the chemical margins have remained weak for Reliance on a YOY basis. But there again, I think I'm taking heart from the fact that the ethane prices have come off. So on a quarter-on-quarter basis, one going forward, one will start seeing slight improvement in the chemical margins for Reliance. Also, I think this will also aid the gas cracker margins for them. The gas EBITDA continues to remain quite strong. Volume growth is expected to be quite robust insofar as the gas volumes are concerned for Reliance.
We have the Ajay, we have the numbers. Ajay, we have the numbers. I mean, if you could just to just sum it up, I think what I'll concentrate going forward is the new energy complex, because that's where I think the company has done 9 acquisitions and has several PILs sort of they have gone in for. I think both the digital as well as the retail numbers are broadly in line. So I'm constructive on Reliance going forward. On ICICI Bank, I think it's a cut about the rest. I think among the numbers that I have seen till now in the banking sector, I think I would say that these are the best numbers. If you look at both in terms of the details, if you look at, I think although the CASA for all the banks has come down, I think they have been able to ensure that the drop in CASA has been most modest. The OPEX on the negative side, has been a bit higher. But that again, I think the company has explained that it's because of the increments that are given in the first quarter. The Kotak numbers, in my opinion, are a bit subdued. So my preference would remain with ICICI Bank over Kotak. Okay,
all right. Your preference is ICICI Bank. The other stock I wanted to discuss is PayTM, and I want to pull those numbers up because the company has now been operationally profitable for 3 consecutive quarters, and they've given a new guidance as well of being free cash flow positive before the end of the year. Ajay, in fact, Goldman Sachs this morning raised their target price on PayTM to 1,200. So your thoughts here, do you think that there is a lot more upside left for someone who's missed out on this rally? Does it make sense?
Good morning, Sonia. I would tend to agree with you because if you dig deep in the numbers, I think on a YOY basis, the losses have come down quite significantly by 40%. And I'm expecting that the company should be cash flow positive as early as the end of the current financial year. And if you look at the 2 metrics, I think the take rate in the lending business for the company at say 3.5 to 3.7% is expected to improve going forward. On the other hand, the take rates in the commerce business, I think, which are moderated to roughly 5 to 6% in the first quarter, again are expected to increase in second half due to seasonality. So on both these counts, I see investors to look at PayTM more constructively, and there is still some more way to run for the stock, in my opinion.
Hi, Ajay. Morning. What about the cement names? Plenty of optimism. Input costs are cooling off. India is growing. Consumption is up. The problem is margins haven't expanded as much as the street was looking forward to. What do you make of Ultratech Cement and Dalmia Bharat's numbers?
I think I am positive on Ultratech more than on Dalmia. And I think if you look at the details in Ultratech numbers, there are multiple positives you can take away with. Just 4 points I'd like to concentrate on. If you look at the operational parameters, I think the cement to clinker ratio is at all-time high of 1.44% for Ultratech. The green power share is up to 22%, should go to 60% by FY27. And the lead distance also has come down to 401 kilometers from 413 kilometers. And the premium product sale has gone up. Now, insofar as costs are concerned, I think expectation was that the drop in the coal and petcoke prices should get reflected in this quarter. Unfortunately, I think that has not happened. And the company is expecting that this should flow through by, say, second and third quarter in the cost numbers for the company. On the positive side, the demand continues to remain quite strong. I think if you look at various segments, I think across categories, when you look at the demand is strong and the utilization levels are around 90% insofar as clinker capacity for Ultratech is concerned and 89% for cement capacity. So I would not be negative on Ultratech. In Dalmia, the East has been particular pain point for them because of large capacities that have come up from rivals, but the Northeast and the South have held on relatively better. My concern with Dalmia is the massive capex, 65 billion FY24, followed by 35 billion in FY25, mainly to fund the JP acquisition. Now, already the company has large debt of 43 billion. So I would urge investors to be cautious insofar as Dalmia is concerned.
Okay, well, thanks for that, Ajay. Stay with us, though, because we're coming back to you for more. And there are so many other names to discuss, right? Credit Access Grameen, I'm going to come to you, Ajay, for that. You know, the big loser last Friday was all technology, large cap, mid cap. I mean, that Infosys pain spread and how. So maybe, you know, a word on that as well in a bit from now. But Anuj is here with us to take us through how he's seeing things. Anuj, morning.
Morning, Prashant. Well, a massive week for the market, right? The most important cue would be the FOMC meet that we have, and we'll react to that right on the expiry day, and the biggest expiry day, the monthly expiry day. The base case, of course, for the market is a 25 basis point rate hike and dovish commentary. And of course, there are two outliers if there's no rate hike or if the commentary is hawkish. So we'll watch out for that. That is the biggest cue. Domestically, of course, the market today will react to 22% of earnings today by the weight. And by expiry, 73% of Nifty would have reported numbers. So, you know, you'll have an easy rollover decision to make on the market. Talking about today itself, it's a test of market's leadership because ICICI Bank will react to numbers. Now, it's possible that higher levels, there's some profit taking because there's a bit of a dip in margin and the stock has had a rally. Though it looks like 960, which was the erstwhile resistance, would now be the support for Reliance. Brokerages also believe that perhaps the numbers may moderate. Kotak's numbers look good, but 2000 is the level where Kotak normally struggles, and there's a valuation headwind here as well. Reliance, now decent numbers, but the stock had rallied already ahead of the demerger, so how much more is there, I don't know. But I think the other important bit is Infosys, because while the FI number looked large, you have to take into account 3,700 crores of delivery selling in Infosys on Friday, and my sense is almost 2,000 crores of that would be from FIIs. The 10-day exponential moving average for Nifty is placed at 19,640, and you know, if you get a test there, my sense is there will be a bit of a bounce from here. Put call ratios come down to 0.91. That's good sign. From an overbought market, you've come straight away to a bit oversold. First support, as I said, is 19,696 based on options, and the most important support is 19,640, that 10-day exponential moving average. I think the index to focus on once again is the Bank Nifty. That's one shade stronger than the Nifty. It doesn't have a problem of a Reliance or an Infosys or any other stock. And the first support would be 45,925, which is Friday's low. And bigger support is 45,750. Options space, though, I doubt it goes there.
Okay, Anuj, thanks a lot for that. Well, you're right. It's a big week of earnings as well, right? I mean, 20% of the Nifty components will be reporting their Q1 numbers this week, so we have our work cut out. So let's talk about some more numbers. Ajay Bodke, before we let you go, wanted your thoughts on HDFC Life. The numbers were actually decent this time. I mean, AP growth came in at 13%. The VNB margins were healthy at over 26%. Any thoughts here, Ajay?
Yeah, I think I had to look at the numbers, and I think the sense that I got from HDFC Life is that it is guiding for a flat VNB margin for FY24, and the margins in the first quarter, I think, were below our expectations. But I think the explanation proffered by the company is that it is essentially due to the front ending of the business that they did in the first quarter, and that's why the margins were under pressure. If I look at the details, I think the non-par business, I think, has experienced better improvement than what the market was envisaging. And I would remain constructive on HDFC Life, although, in my opinion, the valuations, I think, would act as a headwind for any up move in the company.
Okay, well, Ajay, we'll leave it there. I believe that you have to leave us, so I look forward to speaking with you again soon. Thanks very much for joining us. We'll take a quick commercial break here. Mitesh and Sudarshan will be with us with day trading ideas and stock-specific setups. Stay tuned for that.
Welcome back. Hope you're having a good morning. Well, let's get to some technical strategies for the day then. We have Mitesh Thakkar as well as Sudarshan Sukhani who join us this morning. Good morning, gentlemen. Well, Sudarshan, you tell us, you go first. How would you approach trade on Friday, beg your pardon? We had a bit of a pullback, but how would you approach trade given that we're likely to start off 60, 70 points lower?
Yeah, good morning. See, since the middle of June, when we crossed 18,800, there has been only one trade. That trade has been to go long in this market. So really, for almost 6 weeks, all I have been saying is buy every dip and stay long. Now, this view has changed. This view changed when I explained last week that we are approaching 20,000, and 20,000 is a very psychological number. The markets are likely to face significant resistance there. I don't think this is a buying opportunity today or even for the next few days. The chances are that the markets will go into a huddle or maybe into a trading range or become choppy. Maybe we'll go up and down. But whatever the markets do, the uptrend that we have seen for 6 weeks has probably come to an end. It doesn't mean we can't go higher later on or even now. It just means that as far as my trading strategy goes, I'm no longer looking to become a buyer. The trade is now look for small intraday dips and go and buy only intraday. Don't carry any positions.
It's become perhaps a little choppy and running into some headwinds, as Sudarshan explains. Mitesh, would you concur? Good morning. What would your sort of idea for trades be?
Good morning, Prashant. On Friday, I highlighted the importance of 19,700, and I think we got a low right there on an intraday basis. I think that's the area where a couple of intraday or the hourly and 2-hourly charts averages converge. If we can stay above that, then I think it will be consolidation between 19,700 to about 19,980, 20,000, and 300 point kind of a broad range. And then we should be all okay. But in case we start breaking below 19,700, then yes, I would be looking at winding up long positions aggressively as well as exploring shorting again. So for me, I think 19,700 is an important level to watch out for. Below that, I'll be slightly bearish.
Okay, so below 19,700. So that is kind of the line in the sand on the downside. Got it. So Mitesh, until that level is hit, what are the stocks that you're looking at? What do you do with some of these, banking names, and what else on your radar today?
So, good morning, Sonia. I don't have any of the banking names on the list, but I still have more of buy calls, given the fact that we are above that level. So, I have a buy on PVR, good volumes on Friday. The price action was very positive. That's a buy with a stop at 1475 for targets of 1580. ONGC made a fresh swing high. That's a buy with a stop at 168 for targets of 177. And Coromandel Fertilizer is a buy as well. Keep a stop at 964. Look for targets of 1015. On the selling side is HUL. Keep a stop at 2635. Look for targets of 2530.
Okay, thanks, Mitesh, for that. Sudarshan, what about you?
Well, I have a mix. It's buying and selling both. And my assumption is the markets will become choppy. Something will go up, something will come down. Berger Paints is a buying opportunity. The stock made lifetime new highs, and that's usually a cause for celebration. So Berger Paints is a buy with a stop under 675. On the other hand, Dixon is an intraday short. The stock is on the verge of a significant breakdown on the downside. It had a massive rally and then now probably going to match that with a similar decline. In any case, that's the anticipation. So it's an intraday short with a stop above 42.75. Again, Jubilant Foods, it had a clumsy rally and the decline has already confirmed a bearish pattern. Look for an intraday short in Jubilant Foods, the stop above 477. My final list in stock is a buy, that's Godrej Properties. That's a very attractive stock. You could make that into a positional trade also. It's probably completing a small bullish flag and looking for higher levels. Buy with a stop under 1580.
Okay, well, gentlemen, thanks very much, both of you, Sudarshan and Mitesh, and we'll come back to you for more at 9:10. Well, we'll take a quick commercial a break here. We'll come back with our pre-opening rates and the discussion on Reliance. Harshvardhan Dole and Balaji Subramanian of IIFL Securities will join in to take us through what they made of the numbers, the different verticals. So that's coming up. Stay with us.
Welcome back to Bazaar Morning Call. Let's get a discussion going now on Reliance Industries and how you should approach that one. It was a mixed bag actually for the company this time around. They largely met estimates because of the strength in the consumer business. The retail business saw good 20% growth. The telecom business was strong as well, and that offset the normalization in the oil to chemicals business. Harshvardhan Dole, Vice President Institutional Equities at IIFL, and Balaji Subramaniam, the Vice President at IIFL Securities, joins us now. Gentlemen, morning to both of you. Harsh, let me begin with you. What has the summary been of the earnings, and what have you done with your target price, your FY24 estimates as well? Have you changed it in any way post the earnings?
So, frankly, the numbers were, broadly in line or a shade below what we had forecast. And I'd attribute the reason to the weakness in the O2C segment. Mind you, the O2C came in on a very high base. And to that extent, there is a moderation in the overall performance. But I would not read too much into it, given the volatility in the spreads and the evolving macro landscape. But the good part is the other three businesses have done exceptionally well, particularly retail and the E&P segment. Particularly the E&P, where the ramp-up has been actually 2 quarters ahead of time. And that should lay concerns on the issues on ramp-up of gas volumes, etc. So in all, we are not too disappointed with the first quarter numbers, and we have broadly maintained the 10 to 11% earnings CAGR over the next 2 years or so. The SOTP is closer to about 2650, which is where the stock is trading at.
Okay, all right. Sorry, what did you say? 2650 is your SOTP, right?
That's right.
Okay. Balaji Subramaniam of IIFL Securities is also with us. Balaji, overall, it seemed like quite a muted quarter, but the expectation in the medium term is that there are many triggers. Of course, what's happening with JFS, Geo Financial Services. There's the update on the green energy business. Goldman Sachs has valued it at almost $30 billion as a base case. So there's lots happening as we move forward. But based on these numbers, would you change your estimates anyway?
Good morning. Let me be just clear that, I look at the telecom part. So if you were to look at the performance of Geo, it was fairly in line. And the good thing was the subscriber additions were fairly strong. To that extent, there is not much change to my estimates. And what I do believe is that a broad-based 4G tariff hike is probably happening only in the next financial year. I think the near-term triggers to watch out for would be how the recently launched Jio Bharat phone is going to fare, because what we have seen is early in July, the company had started the beta phase for the first 1 million subscribers, and we just need to see whether that results in traction for Jio at the lower end of the market. The other thing to watch out for would be on any potential 5G phone launch. So we would look forward to any announcements that would be made during the AGM, maybe in the next 1 month or so.
Any takeaways for Bharti compared to what you've seen with Jio's numbers?
Bharti's numbers also should be fairly resilient. So what I have is around a 3% QOQ mobile revenue growth. Bharti would also see some tailwinds from the price increases that they took for entry-level plans earlier this year. So the full quarter's benefit a good flow through in 1Q.
Okay, all right. Harsh, coming back to you, what do you see as the next big trigger for Reliance, and anything that you're expecting from the AGM which could sort of, be a positive, either a positive or a negative trigger for the stock? Harsh, is my voice reaching you? Okay, I don't think Harsh can hear me. All right, you want to just summarize for us, Balaji, what your view is on Jio in the sense, based on what you saw in this quarter, both in terms of subscriber addition and average revenue per user, what are you penciling in for the rest of the fiscal?
So as far as subscriber growth is concerned, I am kind of building in the current momentum through the rest of the year. And if you look at what happened on the ARPU front, it was a fairly modest increase. And in the absence of any outright tariff hikes, my ARPU estimate for FY24 is about 184 rupees, which is not significantly higher than what we saw in 1Q.
Okay, 184 rupees, that's much higher than what we saw, as you said. Have you baked in any incremental sales from the Jio Bharat phone or not yet?
To some extent, yes, but those don't move the needle significantly, at least for FY24.
Sure. And this 5G rollout, can you compare it with Bharti in any way? I mean, the Jio 5G rollout versus what Bharti is doing, and would that, change the estimates for either stocks?
As far as 5G rollouts are concerned, Jio seems to be a lot more faster. And I think it has got to do with just the timing of the rollout. As far as Jio is concerned, they have clearly said that they want to achieve pan-India coverage by the end of this calendar. So to that extent, Jio has front-ended its rollout a little bit. As far as Bharti is concerned, I think as we saw in 4G also, it will be a little bit more gradual.
Okay, I think we lost the line there with Balaji. So some issue. I don't know if Balaji is back. But I think we got the bulk of what Balaji was saying. Balaji, if you can hear me, thank you very much for joining us. And Harsh, if you can hear me, thank you very much for being with us here as well. I think 9:06. So just kind of the clock is ticking into the pre-open, into the market opening. If you can have rates up, please, at least the big names in terms of how they are starting. So Nifty is up on your screen. It is absolutely flat. We still got about a minute to go before the end of the pre-open. Let's have Reliance up quickly. Take a look at where that is landing this morning. The stock is down about 2 1/3% in the pre-open. And let's look at ICICI next. So ICICI and Kotak, as I was saying in the morning, I mean, numbers are, especially for ICICI, are spotless, but there are no real earnings upgrades. So the stock is flattish to slight green. And Kotak is, again, I mean, no earnings upgrades. And I've seen a downgrade or two to their full year FY24 estimate. So the stock is down about 1% this morning. So not very much by way of help from at least the big three earnings which we got over the weekend. Just a quick look at maybe the IT names as well. You know, Infosys perhaps after that big fall that we saw on Friday, HCL, TCS, Tech Mahindra, etc. Those should be in focus if there is any interest which starts to come back. Infi is up, HCL is up 0.5% nearly, and some of the others as well. TCS is up about 1/3%. I think we're at the end of the pre-open session now. So not very much on the Nifty. Actually, if anything, IT is the one which seems to be counterbalancing what's happening to some of these big earnings-related names.
Just a couple of more stocks actually in the broader markets. Aarti Drugs is the one that's really shining through this morning after good improvement in margins. In fact, it's been 12% margins for 3 consecutive quarters for Aarti Drugs. That's the big mover there. SJVN is the other one. They've signed a big order, so just keep an eye out on SJVN. That's on the upside. And on the downside, you have CNBC DLM, where there is, I think, some pressure that the company has seen with respect to its earnings. So CNBC DLM is down almost about 5.5 to 6%. So keep that on your radar. PayTM would be interesting as well to see how they're reacting to their numbers. So let's get PayTM on board. Operational performance for PayTM has improved, but the stock is largely flat. Net losses have gone up. So, we'll keep our eye out there. But let's get some 9-10 calls going. Sudarshan is back with us. Sudarshan, looks like it's going to be a flat start. But what do you do? What's the big call at 9-10?
Yeah, it could be a flat start and choppy for the Nifty. The big call is look at Godrej Properties. Consider buying the stock for a positional trade with a stop under 1580.
And Mitesh, what about you?
I'll go with the buy on PVR for targets of 1580.
PVR. Okay. PVR was up about 4% and the pre-open is up about 0.75%. Just a quick word, Mitesh, if you will, if you can look at emphasis for us. If there is, lots of varying views, and at least fundamentally IIFL has downgraded their rating on the stock. On the other hand, Spark, which is now Avendus, IIFL is downgraded and Spark is upgraded. So lots of views. We had the management with us on Friday and they said, well, things will have bottomed and they will sequentially improve from Q2 onwards. But chartically, how is this one looking?
I think I'll go with what the management said. Couple of reasons. In the last 2 weeks, this stock has rallied from levels of around 1850 to about now at 2300 plus. And this is the level where the stock had peaked out in August. August high was around 2387 and we saw the stock correct from there. But the pace of this last 2 weeks rally is very strong, suggests that even if we take a pause over here around this 2320 mark, eventually the stock will go much higher. And I would look at, targets in the range of 2550, 2600 levels. So still about 10% kind of an upside can happen. From a trading point of view, you might want to enter on dip, but if you're holding the stock, there's no doubt, just keep holding the stock. At least 10% upside should happen in the next 2 months.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's hop across to Abhishek. He's joining to tell us about Credit Access Grameen. I think the first tick was well in the green and PayTM as well. Abhishek?
Well, to begin with, PayTM, it's operationally, sequentially a weak quarter for them. Total income is down, or let's say largely flat on a sequential basis, and it's up 38.3% YOY. Remember that in Q1 of last year, it was up 9% quarter on quarter. Contributor profits have actually grown by about 79.5% YOY and 1.6% sequentially. Last year, same quarter, it was a growth of 34.5% quarter on quarter. Contribution profit margin have expanded both YOY and quarter on quarter. However, net loss have widened on a sequential basis to 358 crore when compared to 167.5 crore in the previous quarter. GMV, that is gross merchandise value, that's up 35% YOY and about close to 11.9% sequentially. Brokerages have a target price ranging from as low as 800 per share to as high as 1200 per share on PayTM. Credit Access Grameen, it's a stable quarter. Asset quality has improved sequentially given the fact that write-offs continue to remain elevated at 100 crore plus in this quarter as well. Disbursements are up 122.3% YOY. AUM growth is at 40% YOY and about 3.5% sequentially. The NII growth is pretty robust at 19% YOY and 14.5% sequentially, which means that the net interest margin is at 2-3-year high of about 13%, and that has helped the PAT growth to be robust at 86.3% YOY and about 37.5% sequentially. Back to you.
All right, appreciate it. Thanks for that. Let's go across to Sonal now. She's tracking IGL this morning. Sonal, over to you.
Thank you so much for that. Well, IGL reported numbers, and while the margins were in line with estimates, it was a volume miss, and that is something that could be negative for the company. Revenues were down 7.5% on a quarter-on-quarter basis. EBITDA was up 38%. Margins expanded to 18.8% versus 12.6%, and this was largely because of the gas cost cut that came through in the first quarter this year itself. Profits were up 33% as well. Now, total volumes came in at 8.2 MMSCMD versus 8.4 MMSCMD, and it is a decline on a quarter-on-quarter basis. If we look at the EBITDA per SCM as well, it came in at 8.6 rupees versus an estimate of 8.7 rupees. And if we break up the volumes as well, the CNG volumes were up just 4%, which is the major driver of the volume growth. PNG domestic volumes were up 20%, and industrial volumes were down 1.7%. It's surprising that the CNG volume growth has been muted, despite the fact that the company did not take price hikes when the gas prices were higher, but they did pass on the price cuts. So ideally, volumes should have been higher than the amount that we have seen right now. Jefferies has a buy rating with a target price of 565. They say it was a margin-led beat, but volumes fell quarter-on-quarter, and they were 2% lower than what Jefferies was estimating. CLSA says that, yes, EBITDA was up 38% sequentially and in line, while other income drove a 4% miss in first quarter PAT. Volume growth was at a multi-year low, and that is something that they don't like as well.
All right, thanks a lot for that, Sonal. Well, Vedanta is under some pressure. The stock is down close to 2% in pre-open. I think the higher debt number has spooked the street a little bit. So on the operational front, well, the numbers were a bit of a miss, but that's par for the course actually with regard to Vedanta. We already had Hindustan Zinc's numbers with us, so X of Hindustan Zinc is where the miss did come in there. The debt, well, it's moved up by close to $2 billion, and Citi has cited this itself for their downgrade. They downgraded the stock to sell, target price of around 225. They're saying that the company is paying out higher dividends in comparison to what it's receiving from Hindustan Zinc. They're also paying that brand fee to the parent, that's Vedanta Resources, of around 3%. And also now they'll have the semiconductor unit in the listed entity. Put all these factors together, they're a little bit worried on the leverage front. That explains why they downgraded the stock.
Okay, well, we're just heading into the market opening. So it looks like it's going to be a very flat opening. But here are some of the internals, right? Reliance is down 2.5% ahead of the market opening. Looks like the street is a bit concerned about the weakness that we've seen in the O2C business. But the consumer business was very strong. Kotak Mahindra Bank as well, some profit taking, post a decent set of numbers. And on the upside, the big mover is ICICI Bank, up 0.8%. A couple of double-digit movers actually would be interesting to point out. Aarti Drugs has seen very good improvement in margin, so that one's up 11%. Titagar Wagons had a good set of numbers. That one is also up about 6-7%. And Credit Access Grameen is reacting to its good set of numbers. So just heading into the market opening, lots of big cues today. So there you have it. The first tick on the index is in the green, up about 10 points. So very quiet, but with a bit of a green bias to it, which is, I guess, what the street would like. Okay, now drifting into the red. So suffice to say, very, very flat opening. It is led by Kotak and Reliance on the downside. So these are the big index losers. Kotak Mahindra Bank down 2.5% and Reliance down almost about 2%. Apart from that, you have Apollo Hospitals, Eicher Motors, Grasim, that are a couple of other stocks that are in the red right now. And Asian Paints is also trending lower, down about 0.3%. Bharti Airtel, after Reliance's numbers, Bharti Airtel is slightly soft as well. So just keep your radar on that. On the upside, Infosys is coming back a little bit, up about 1%, followed by HDFC Life. A decent set of numbers this time from HDFC Life, actually, and that stock has not performed at all in the last many weeks and months. The AP growth for HDFC Life came in at 13%. The VNB margins were 26% plus. And remember, the stock has corrected below its 20 and 50-day moving average. So HDFC Life could be one stock on the upside. Apart from that, all the IT names, Infi, HCL Tech, Wipro, all in the green. Tata Motors comes out with numbers tomorrow, so just keep an eye out on that. 0.3% higher there. Hero MotoCorp also in the green. So now very, very quiet for the frontliners. But in the broader markets, there are some good result reactions.
Well, that's right, Sonia. In the broader markets, you have Aarti Drugs. The stock is up and about. Utkarsh Small Finance Bank. It had a good listing. Stocks building onto those gains. Volumes as well, tremendously high. It's up more than 10% odd. You have Titagarh Rail Systems as well. That stock as well has opened up well in the green. And RVNL as well. That stock continues its march upwards. Suzlon Energy now it's a 20 rupees stock. It's up close on 4.5%. And volumes very, very high. Ircon as well joins the list with a gain of closer around 3%. On the flip side, Vedanta's under some pressure. The rising debt is something the street doesn't like too much. RBL Bank has moved into the red as well. And Canara Bank more or less flattish ahead of its numbers. But par for the course kind of opening, 19,720 odd.
Nigel, even without any great help from the big earnings over the weekend, the index is doing just fine, right? 15, 18 points lower, which is neither here nor there. It's flat for what it's worth. So, right out of the gates, big volumes on so many names across the board. And the big winner seems to be, of course, Credit Access with that 6-7% kind of a pop. Aarti Drugs is the other one, which is up about 10-11%. And again, volumes here too seem to be pretty solid. But other than that, let me just kind of quickly scan this list here to see what else is happening. IRFC, all these rail PSU rail companies, IRFC, Railtel, Ircon, RVNL, they were all up between 4 and 8% on Friday. And I think they pick up where they left off with strong gains. Dodla Dairy will come up on your screen. These dairy companies, again, 2 or 3 days in a row now. Parag Milk, this one, Hudson Agro, these have been buzzing. So that, once again continues. SJVN, let's have that one up. Satluj Jal Vikas Nigam, that is 9% higher. So that's a big one. We had that note from Goldman last week, I think middle of last week, where they were highlighting some of these names, NHPC, NTPC, SJVN, etc. Mazgaon is up about 3%, apart from what we've already mentioned. On the downside, maybe 1 or 2 names, Kotak, Reliance, Vedanta. You've got AU Bank, all lower. JSW Steel, JSW Steel saw a spike on Friday right out of the earnings, but then kind of slumped, and it's down another 1%. Or so. So that's what we have. Sonia.
By the way, PVR Inox is at a fresh high. So whether you like Barbie, whether you like Oppenheimer, there's one person laughing all the way to the bank, right? And that's PVR. It was almost 300 crores, by the way, the collections on Barbie on day 3. Yeah, no. So that's been phenomenal. It's been.
So PVR are doing well on your screen. Well, Dheeraj Agarwal is now joining us, Managing Director at Ambit Capital. Dheeraj, great to have you with us here on the program.
Hi, morning.
Glad you could make it to the studios. Raining still outside? And
Not really right now. And it's been nice to be back in the studios rather than on the Zoom.
It's great to have you here.
Great to have so impersonal, yeah.
How are things looking, Dheeraj?
So not too bad, I would say. So markets had a fantastic run. So a little bit of a sideways consolidation here is not completely unwarranted. But overall outlook continues to be good. I think by and large the earnings season has started off well with a few disappointments here and there, which is par for the course. So, but at this point of time, clearly market is looking for growth. I call it the growth chase. So any company sector which is reporting good growth numbers or relatively better growth numbers as compared to its peers or other sectors are finding favor in the market at this point.
We got one big dhamaka earning, right? Polycab, where it was big beat. Yeah. Apart from that, we've not seen very much by way of meaningful earnings upgrades. Numbers have met, etc. But that's yet to come. Maybe it'll come. We're still early in the results season.
It's a very diverse kind of earnings performance at this point of time if we see it, right? So when Polycab is one extreme example of a fantastic set of numbers. So I mean, if you see one thing which is there is that on the demand side, on consumer demand, we saw that in Hindustan Unilever numbers as well. That's beginning to look a little bit weak. But at the same time, on the investment side, the gravy train just continues. So we are seeing good credit growth, good amount of capex growth, etc. So that relative shifts keep on happening in the market at all points of time. And stocks are rotating very, very fast in the current cycle as compared to what we have seen before.
Okay. By the way, I just want to mention that the headline index may be flat, but there's plenty beneath the surface that's doing very well. I mean, just look at this, right? SJVN is up almost 7%. Credit Access Grameen is now up almost 7% as well. And we were pointing a couple of these stocks like PVR that are hitting fresh highs. Canfin Homes is up almost about 5-odd%. APL, Apollo Tubes. So there's plenty to choose from. But I wanted your thoughts, Dheeraj, and good morning once again, on banks, right? The numbers are good, but the rally has also been pretty sharp. I mean, ICICI Bank is up over 20% from the lows in March. Do you think there is further scope for re-rating?
I think there is. It will not be as sharp as what we have seen in the initial part of the re-rating, right? So a lot of valuation discovery is already done. From here on, to expect the kind of movement that we saw in banks in the last 2 years is not going to be easy. In fact, even at the index level, it's going to be more moderate and 12% per annum kind of a performance. So it's not that market's going to run away despite a very strong economy, because there are, as we discussed right now, there are sort of offsetting factors. So it's I like to call it, it's a bit like a sine curve. Something is going up, something is going down at all points of time. So tech is dragging down right now. Consumer is looking slightly weak. I'm not saying collapsing, but slightly weak. But at the same time, the whole capex cycle, spends out there, credit growth, all of that is looking strong. So we'll trudge along.
All right, what's the pecking order, Dheeraj, then? I recall in the past you've said, I think SBI, Axis Bank and ICICI Bank, I think they were the top stocks that you were interested in.
Yeah.
Does HDFC Bank get a mention in there, or would you stick to these top three?
So I would stick to this top three. HDFC Bank, it's consolidated over the last 2.5 years. So it's certainly looking interesting. So valuations are no longer as stretched as at what it used to in the past. And there's a sort of a divided street on HDFC Bank at this point of time. Do they go back to the glory days and become the premium sector, premium position again, or does ICICI Bank take that spot? So ICICI's consistency of delivery is absolutely outstanding. So between the two, if you would still force me to pick one, I will say ICICI. It's like the wall.
Okay, all right. So we got that banking, query out of the way. But we are speaking about auto stocks as well earlier this year. Yeah. And I recall you mentioned from the two-wheeler space, the Royal Enfield is something you like, Eicher Motors and Tata Motors.
Correct.
How do you approach Eicher Motors in particular? Because suddenly you have, competition that's coming in there, which as a bike lover, I never had that. I mean, and from a shareholder's perspective, suddenly they're looking at Bajaj Auto, Hero MotoCorp, because they're going to give it a bit of a challenge with the tie-ups that they've done. Would you buy Eicher on the dip?
I would buy Eicher on the dip. I'm sure some challenge was bound to come. It's not a surprise. Eicher is like Mr. Bajaj actually said it in public, right? That Royal Enfield is a bank and we're out there to rob it.
Yes. Yes.
I mean, why not?
He knows how to make these statements, right? Let's stick.
Right. So everybody's talking about it. And Eicher took a beating as soon as Triumph and Harley-Davidson pricing got announced. Sure. But at the same time, we have seen this competition trying to nibble at Royal Enfield before. So RE has got a nice definitive niche in pricing. And more importantly, they are creating a completely new segment in the global market, in the 350cc to 450cc or 500cc range. That doesn't exist. So they're actually literally expanding the market, and they're doing it very well. So I think Eicher will do well. I'm not saying competition will not do well, but it's a huge market, right? So I would buy Eicher on the dip, yes.
I was debating whether or not to go ahead and buy the Bajaj Triumph. I haven't yet got to test ride it. And Sunny, a friend of mine, said that, but Nigel, there's a 750 that's coming in from Eicher in the next 18 months. Yeah. So what about that? So I was like...
Problem of plenty, right?
Yeah. Good news.
Good news, definitely.
But there you go, you're waiting for Eicher. That's good news too.
But you know what? This also speaks a lot about not just demand, but even demand for electric vehicles, right? I mean, anyone and everyone you talk to now is looking to buy the next EV.
That's right.
So what do you do as a stock market observer? Do you pile on to EV stocks, or do you think that story has largely played out? Not just Tata Motors and Maruti, but some of the auto ancillaries as well.
No, I think that story is a long way to go. So EV conversion will keep on increasing. Somewhere slow, somewhere a little fast. So Tata Motors has done a phenomenal job in the four-wheeler EV space, 80% plus market share of a small market arguably, but still 80% plus market share.
Sure.
And the group is now foraying into making batteries and investing in tech out there. What if they do some kind of a breakthrough cost reduction in the whole battery technology, which is the most expensive piece of an EV, right? So I would continue to invest in EV and look for EV investments. I mean, obviously, some parts of it might be a little bit of expensive or bubbly, so the valuations have to be kept into mind. So TVS's EV strategy is fantastic. Maruti yet to completely get there, right? But Tata Motors has done really well. So there are all, in iShares case, obviously, that kind of segment, there is no EV yet. So they're a little bit of, in some sense, they're shielded from the EV conversion. But let's see for how long.
Dheeraj, you mentioned consumer looking a little weak, and you said IT also is on the weaker side. But those are areas where maybe not IT so much, but consumer is where, at least at the lower end, you can find stocks which are actually which have been bombed out. I mean, actually we had someone on Friday. Hiren Ved was with us of Alchemy, and he was saying that he'd buy some of these, lower end of the consumption space where perhaps there could be a recovery. Would you bet on that kind of a thing? Because
so I'm not,
at least the price is on your side, maybe.
Yeah. So I'm not so on top of the smaller consumer names, but the larger consumer names are not really cheap, right? And there again, within the whole consumption basket, there is no one single story which is playing out. So the paints volume are still doing well, whereas we saw FMCG volume struggling a tad. In consumer discretionary, there are some segments which are doing well, some not so well. So, India has become, from that point of view, a very, very diverse
QSR,
economy.
for example. I mean, names like Jubilant Food, etc., which have been languishing for a while. Would you want to take a bet on those kind of names?
I think it might be a bit early. The valuations, I don't think, are still down to a level where they become compelling. And QSR's valuations, with respect to its own history, has to be seen in the backdrop of competition from aggregators like Swiggy and Zomato, right? So Jubilant pre-Swiggy and Jubilant post-Swiggy are two different stories. Earlier, when you thought of a food delivery and you wanted food within 45 minutes, you would just say, at least it's reliable. It'll be at your doorstep in 30 minutes. Now you think of which food category to choose from. And second, even if you think of pizzas, then you say, okay, maybe today I should try Smoke and Joe's. Because Swiggy can deliver it, right, within the same 40 minutes.
So you continue to remain positive on Zomato. I recall in the past you were quite positive on it, right?
Yes.
So hold on to that view.
Yes.
Okay. In fact, I should tell you, Swiggy and Zomato now, Swiggy, of course, has Instamart,
That's
right? And a lot of the other players have it too. In literally like 5 or 10 minutes, you get groceries delivered to your place.
Yeah.
So forget about food, right? I mean, groceries are coming to your house like in 5-10 minutes.
Yeah, I ran out of soda at home on Sunday when I was hosting a brunch, and I just installed 5 minutes.
You can invite us next time.
Interesting one.
Will do.
All right. Thanks a lot for joining in. Appreciate your thoughts here.
Thank you so much. It was a pleasure coming.
Thanks, Dheeraj.
Thank you.
Okay, by the way, for the markets, it is now taking a little bit of a dip into the red. So just keep your eye out on that. All 4 indices are in the red. The Sensex, Nifty, Midcap and Bank Nifty. Nothing alarming, but just slightly subdued. And what's exerting pressure on the markets is definitely Reliance, down 2.5%. Kotak is also down. And JSW Steel, Tata Steel are a couple of other companies that are in the red.
The Bank Nifty, Sonia, that's the one that's recovered a goodish bit from the low point of the day. So I think if we get the intraday chart on that one, it'll tell you the picture. The Nifty Bank, from being down, I think, more than 100 points, it's seen a bit of recovery from the day's low. So that's good news as well.
Okay, well, let's move on. Then JSW Steel, as I said, was a stock under a bit of pressure, down almost about 2% or so. The company reported a solid set of Q1 numbers, benefited from the lower input costs, while there was a big improvement in the overseas operations as well. Nigel had a chance to speak to Jayant Acharya, who's the Joint Managing Director and CEO at JSW Steel. He began by asking him about their realizations, which were higher, and also the EBITDA per ton. So let's listen in and we'll come back.
Yes, so our results in terms of EBITDA per ton is on a consolidated basis. So we have declared results on consolidated basis, and our EBITDA per ton is 12,345 rupees per ton in Q1, which is slightly higher than the Q4 numbers. The India results on a consolidated basis include our operations at BPSL, and that number is about 11,800 rupees per ton EBITDA. The prices in Q1, we have been able to, while the prices did correct internationally as well as domestically, we were able to set off some of that with a better export booking, which we had in the earlier months, which went into Q1, and also a better mix of value added and geographical mix, which we could manage. With that, we have been able to get a realization which is slightly better than Q4.
So two-part question then. Could you tell us prices as of today, how does it compare with the average of the past quarter? And also coking coal cost, you had alerted us that it's likely to go up in this quarter in comparison to last quarter. How much higher has it gone?
So coking coal prices last quarter was about $274 for us. And in this Q2, we expect it to go, in Q1, it has gone up to $285 per ton. So it's gone up by $11.
All right. And realizations as of today, how does it compare with the past quarter? And coking coal as well, will it slide from this $285 per ton?
Yeah, so realizations past quarter, I would say the price corrections, as all of us know, has happened in the global steel industry per se, and that has been reflected in India as well. The exit numbers of June have seen a better part of correction, and it will part of that impact will be seen in the July-September quarter as well. But the coking coal prices have corrected, and therefore the cost will therefore go down, and we expect a $45 to $50 drop in coking coal prices going into Q2.
Okay, so EBITDA per
which will offset any kind of price impact there.
So EBITDA per ton then will improve from here on, right?
I would say that we will be able to, margins would be range bound. It would be difficult to comment exactly on how the prices would move, but yes, I expect prices to have bottomed out, and so therefore the margin should be range bound.
Now, US and European operations, out there, if I calculate, the EBITDA has come in at more than 550 crores. That's much better than what we have seen in the past. Do you expect this US and Europe operations to continue delivering that 550 crores on a quarterly basis?
So you're right, your overseas operations did quite well in the last quarter. Our overall overseas EBITDA was 570 crores. Baytown, the plate mill, delivered good numbers with an EBITDA of $45 million on better volumes. In Ohio, also, the capacity utilization went up. So from a negative EBITDA last quarter, we have become positive, $2.6 million of EBITDA in Ohio. Again, on the back of good volume and capacity utilization. In Italy, again, very good numbers on the back of rail orders, on back of a good capacity utilization of 88%. The overall EBITDA at 18.6 million euros have been very good. So the overall overseas have therefore been very supportive. Having said that, I would also like to say that, as we know, some part of the global headwinds exist, and some price corrections which have taken place already may play out in this quarter. Also, there's a holiday season during July to September in various parts of the world. So therefore, there could be some impact of that playing into this quarter.
So what is the run rate we should work with then for the overseas operations?
It's difficult to give a run rate, but I would say that Italy will continue to do well. Italy has good orders in terms of the rails from the Italian government and from international export orders as well. I expect the Baytown operations to do reasonably well because the renewable sector is consuming a lot of plates. The Ohio operations, because the prices have gone down, while the capacity utilizations will be better, there may be a pressure on the margins in Ohio.
Got it. All right. There was this other article a few days ago that said that JSW Steel is looking at picking up 20% stake in a coal mine in Canada. Do you want to clarify on that? Are you all interested? If yes, at what valuation?
So we are looking at raw material security, and our aim is to have iron ore security and coal security as we build our capacities in India. We are also looking at metallurgical coal assets in the world, good metallurgical coal assets in various parts of the world, including Australia and Canada. Tech is one of the assets we have looked at. However, there is nothing at this point of time I'm able to comment. It's just an initial kind of a feasibility study which we are doing. So as and when we are in a position to give any comments, we'll come back.
Where is that NMDC steel bid now at? You all were interested. Where has it moved?
Yes, so we have filed our expression of interest and the data room has opened and we are having access to the data. So the study is going on right now and we will take a decision at the right point.
Will you be willing to pay $1 billion for $1 million?
It will be very difficult to comment on any kind of payment or valuation at this stage.
Okay.
The data room numbers are just coming in. We will have a look at all the numbers which come in and then take a view as to what we can do.
All right. Final question then. What about the debt number? Where is it headed from here? On a quarter-to-quarter basis, there's been some increase. At what level, absolute level, will the debt number peak out?
So there's been an increase on account of some of the working capital increase which has happened. Two reasons. One, we have paid high cost metallurgical coal imports. We have paid out and that has gone into the working capital. The second one is some inventory additions which have happened in Q1 due to channel destocking and some impact which we had on sales due to the cyclone in the later part of June. So some of the material has got held up at the ports. So this has gone into the working capital. We expect once the merger of JISPL is completed, we expect about 3,000 crores of debt to get consolidated. However, we are looking forward to reducing the working capital impact which has gone up. And therefore, the date closing for this year would be in a situation better than what you probably see today.
Okay, that's JSW management chat. Just quickly want to highlight what's happening with Emphasis. The stock is down 4% now. So I was pointing out to that IIFL downgrade which has come in this morning. So that is the one which the market seems to be paying attention to, not some of the upgrades on the other side, which have been actually based on minor tweaks, multiple tweaks, etc. P multiple tweaks, but that's a large cut on a widely tracked name, Emphasis. And Credit Access is the other one which will come up on your screen next. That seems to have cooled off quite sharply actually from the day's high. The high was 1426 and we've given up almost $50 from the day's high. Stock's at about 1383, still 5% on it though. We'll take a break here. You'll actually hear from the Credit Access Management, Udaya Kumar Hebar, Managing Director and CEO of Credit Access Grameen, with us in a bit to talk about the numbers. And then we'll have Sanjay Agarwal, Managing Director and CEO at AU Small Finance Bank, also joining in to discuss their quarterly performance. Stay with us.
Welcome back. This is Corporate Trade Hour. Well, let's get straight to the management of Credit Access Grameen. The stock is surging after reporting a very, very good set of numbers in the first quarter. Net interest margins come in at the highest we've seen in 3 years, while asset quality as well has improved, aided by write-offs. To discuss more on this and their performance as well, we're joined by Mr. Udaya Kumar Hebar, the MD and CEO of the company. Good morning, Mr. Hebar, and congratulations on a very, very good set of numbers. Couple of questions first. Could you tell us whether the tenor of the book has reduced in the first quarter if I compare it with Q4? And also, do you want to up that AUM growth target that you had given us last time of around 25% because of such a solid start in Q1?
Yeah, there is no change of tenor in our book. It's as usual. We had about 29% 3-year tenor loans, which remains same as of Q1 also. And on the guidance, it's a sector, definitely it's a good quarter. We actually grown with the customer acquisitions, grown with the good disbursement, compared to YOY. We have a very good numbers across. But we want to wait one more quarter to see and then review if there's a change in our guidance. But at this point of time, we are sticking to our guidance and we'll review after a quarter. We definitely observe a very good trend, and not only for the company, even for industry, we feel that this is going to be a good year.
Okay, all right. So you're sticking to 25% for now. Just one more question on your book. Geographically, you seem to be spreading out a little bit from your core home states. What's the plan going ahead?
It is a continuous process. We keep improving it. Actually, for last 1 year, our beyond core market, we increased almost 25% now, 24%. Customer level, it's about 33%. It's very, very good, actually. So I think, it's a continuous district-centric approach, and we keep adding districts around our operations. Contiguous district approach helps us in building a strong book with quality, replicating our operations very well. We continue the same process. This will be, as usual, by next 3 to 4 years, the core market should come down below 65%.
Okay. Mr. Heber, good morning. I wanted your thoughts also on what's happening with asset quality. There is an improvement this time around, and your asset quality, your gross NPAs are under 1%. But because of the inflation situation, because of the floods, has there been any stress at all in the book? And if yes, what would the asset quality range look like by the end of the year?
No, actually, there is no any significant issue anywhere in the country, anywhere in our operations. Our asset quality improved further, and even now with that below 1%, we have little legacy book of the acquisition. Actually, if you take out, that's actually much less than 0.7% is our gross NPA. If you look at at a 90 days basis, it is just 70 bips, not even 89 bips. Because we consider NPA at 60 days basis. So I don't know whether you are aware about it. Actually, no. So therefore, asset quality is quite good. What we guided is 1.6 to 1.8% is of credit cost, and we are definitely within that. We'll be able to maintain within that.
Okay. Another, Mr. Heber, hi, good morning. Another data point which was being highlighted is that the share of unique customers for you has fallen from 43% to 34%. So the share of customers with 2 or more other lenders has gone up quite substantially. How should one read this data point? Does it lead?
It is slightly changed because as we go to newer markets, we acquire customers. We may be a part of one customer, one lender already. So therefore, as you grow more and more beyond our core market, there's a higher chance of acquiring from other customers. Competition will play definitely. But the important point to see is within 12 months' time, if you see, almost 11% of customers actually slowly lose all MFIs and becomes unique customers for ours. So that's actually, it will keep on, we keep on lending more to other customers. We keep on acquiring the customers from different geographies. So if you look at more than 3 lenders, I think it's hardly about 11% or so.
Just to, it doesn't in any way indicate to any potential future stress. I mean, high indebtedness and then...
Not really. What happened is the regulator removed that cap earlier. So earlier there was a cap. Now there is no cap. Now any lender can go and lend to the customer whom we already lent. So I think that one change can increase the number of lenders. But in the meantime, regulator also put a cap of the FOIR, not more than 50% obligations to be maintained by every MFI. Therefore, this process, there is a good customer protection by every lender. Therefore, if there's a more than 1.5 lakh consecutive loans, we don't lend to them. So automatically, we ensure that the asset quality is protected.
All right, Mr. Heber, the other bright spot of your numbers was the NIMs. Came in at around 13%, the highest in multiple years. So that's pretty good news. Now, I'm aware that, the rate that you are giving out loans has gone up a little bit, but your cost of funds as well has gone up. So taking both of that, on board, what could your NIMs look like from around this 13%? Should we see it tapering down a little bit? And for FY24, what should it look like?
So we guided 12 to 12.2%. Yeah, as I said, it's actually good improvement. And we expected some more cost to go up in this quarter, but Fortunately, we are able to control that. Therefore, NIM looks a little better. But as we use the capital, it will come down a bit. So because of the change in the overall capital adequacy. But still our guidance is about 12.2. We will review after a quarter. Maybe it may go up to 12.5 if everything goes well.
Okay. And, you spoke about how your overall growth, you'll stick to this 25% growth guidance. But I want to understand on the customer acquisition and loan growth, on an average, what are you looking at? I mean, what would the normalized, say, compounded growth be over the next 2 to 3 years? Will it be at 25% or would it be lower than that?
So actually, we guide about 20 to 25% in terms of portfolio growth, and as well as 15 to 18% customer growth. And actually, we guided almost, next 4 to 5 years, we should be able to reach a 50,000 crore portfolio book. So that is what we did guide in the last analyst meet on May 18th. We actually precipitated this, assuming that 4 to 5 years, we should be able to reach 50,000 crores for microfinance book.
So on the portfolio book, you're saying 50,000 crores over next 4 to 5 years. But any target that you have in FY24, it will be about 18% growth in your customer book. That's what you're saying?
15-16% customer growth and 24-25% portfolio growth. Have we already guided? So we will be able to achieve that.
All right. Mr. Heba, the last time you joined us, we had quizzed you about the promoter entity looking to bring down their stake. And you said that could be likely in the coming year. Our viewers as well as your shareholders remember that. And in the coming weeks, you went ahead, the promoter entity has diluted close to 5-6% odd. Are they done, or will the promoter entity dilute further? Because I think the earlier guidance was around 10% odd is what you want to bring it down by.
Correct. So if you look at, it was one of the requirements what we have been requesting the promoter, if we can reduce a bit, which can help us to enhance the investor base and enhance the floating shares, which largely we done, including the promoter stake sold about 5.7% and about almost close to 2% based on the swap. With the last leg of the acquisition, I think overall almost 7% has been already diluted. Our floating shares almost 33%, which is quite good currently. I think, largely what we intended to do has been completed.
All right, Mr. Hebert, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts. That's Credit Access Grameen. The stock is up almost about 4%. So they're talking about a good growth in excess of around 20 to 25% overall, and also a 16 to 18% growth in the customer book is what they're looking at for FY24. So that's Credit Access Grameen. But let's do one thing. Let's get a handle on what's happening in the market now. Very quiet, actually. Not too much action as far as overall movement is concerned. Let's take a quick break and we'll come back with lots more.
Okay, well, AU Small Finance Bank is with us as promised. The stock is slightly lower in trade. The numbers came through. Net interest margin is the slight bit of niggle here. We've got the management joining us, Sanjay Agarwal, Managing Director and CEO at AU Small Finance Bank. Mr. Agarwal, great to have you with us here. Good morning. Pleasure having you with us here on CNBC-TV18. On all parameters, the numbers look pretty good. The one niggle, as I pointed out, seems to be the NIMs, which have contracted. Can we start there, sir? What happened?
So, Prashant, it's very natural that in this high interest rate regime, right, and we are a new bank, we are just in 6th year of our journey. So, when you're in 6th year of your journey, right, so you need to do something for your customer to really raise deposits, right? So, in that sense, I'm sorry.
Come on, Mr. Agarwal, we can hear you.
Okay. It's all right. So I'm sorry for this. So Prashant, we are a new bank in the journey of, right? We're just 6 years old. So we need to price our deposits, in terms of the other established bank, universal banks. We need to price them better, right? Otherwise, people won't give you deposits as of now. It could take some more time to build brand, product, service, all those things. So, and in this high interest regime, it will naturally happen, right? And we also deal with the customers who we don't deal much on floating rates. Our 65% book is your fixed and 35% book is your floating, right? So it takes the challenge. But I think last quarter we also had surplus liquidity. So I think NIM pressure was supposed to come. I told my entire ecosystem that last year itself that this interest rate cycle movement will happen, for next 12 to 18 months, and we are into the cycle now, right? So, but it is for me now. There's a pause on interest rates hike, as of now, and I believe that once it gets reversed, so we'll be get more benefit out of it.
Okay, Mr. Agarwal, good morning, and thank you for joining us.
Yeah,
but
good morning.
You see more pressure because it's not that the pressure was not expected. As you said, everyone knows that cost of deposits went up. But this is from your highs, 6.3, you've come to 5.7. It's a 60 bips fall. So is there more?
No. Lata, so it has a two aspect of it because, we started commercial banking lending also, which is not a higher rate. We just lend around 10, 11% in those assets also. So the mix is also getting changed. Of course, the benefit of
mix is getting changed. Mix is getting changed in favor of what? Large corporates?
No, that's we can't do that. Large corporates, right? We're still a small finance bank, but our 90% is retail asset, right? 10% is that. But in the sense that we were dealing around 25 lakh to 50 lakh, like kind of loan where we deal around 14 to 15%. But the moment we moved around 1 crore to 5 crore bracket, we can't price that level, right? We need to price it at around 10-11%, right? So that's why, in last 2 quarters, it was around because of mix getting changed, And now, in a high interest rate regime, we need to borrow money, right? We need to take our deposit to the next levels. It's a mix of both the things, right? And I expect that most of that has been arrested by this quarter now, but there may be a case where, if there is a hike interest rates going forward, then again, there can be pressure on NIMs. But largely, I will say we have already covered largely in our last one, this quarter only.
Okay. The other point of bother could be that in the interest to keep your margins, you go in for high risk, high return assets. And that may be showing already in your slippage ratio. It's slightly higher. As well, your GNP is about 10 basis higher. Is that a worry now? Especially, unsecuritized loans are the first to get impacted by higher interest rates.
No. Again, Lata, one thing I can assure you people from this platform is that we are known for our asset quality only, right? So there is no concern around it at all. I think it's more cyclic. We were around 1.66 in March, which is too good a data, right? And then it has to go a little bit here and there, which is 1.76 as of now. So there is not at all any worrisome there. Second, we don't do much unsecured, right? We have 1,000 crore of personal book and maybe 1,000 crore of our credit card book. Other than that, this entire piece is secured, So close to 95% is secured, right? 90% is retail, right? So I think we should not read much around it. There are certain slippages, which is very normal in course. The first quarter generally happens like this, and this is the first quarter, after COVID and all those things, which is now getting stabilized, right? So I think we should not read much around it. We are absolutely in control of our asset quality.
Okay, that's good to hear. It's just that CIBIL also was raising some red flags on lower denomination loans. They had also raised the red flag.
We do secure. Again, I repeat that 95% assets are being secured. Secured in the sense from the primary security or a collateral one.
Okay. The cost of capital the total cost to income has still inched up a bit. Is that the highest, or can we see it? You had gone up from 63, I think, to 65% in terms of cost to income. Will you see it receding? Is this the peak?
Yes, I would say again, we'll keep investing in this franchise. We have built the whole digital franchise. We have built the whole commercial banking franchise. already built a very decent branch banking liability franchise. Now we need to build the TBG group because we just got the ED1 license last quarter only, right? So I think the investment in the bank will continue, Lata, because I strongly believe that generally bank takes around 10 years to really be at size, scale, and stability, right? And we are just 6 years old now, right? So give us some more time, right, to stabilize it. But because 1% here and there, in a discussion looks very high. But once you do in operational level, right, 63 or 65 doesn't have much difference around it. So I would think that it would be in a similar level the way we handled last year.
Yeah, but you said, banks take 10 years to stabilize. Do I hear an ambition to apply for a universal bank license then?
So, Lata, again, I would say, as I repeated many times, that we are playing our inning, right? We have to play on the platform which has been given by this country and the regulator, and we need to apply ourselves to the core of it, and it's up to the regulators and the country to decide.
No. I'm just asking if you will apply. Will you make a request anytime?
So aspiration will always be there, right? Because, when a cricketer played a Ranji Trophy, you want to play a test match, right? When he played a test match level, you want to play at world level, right? So I think the topmost platform is universal bank, right? So there's no denial of it, but we are not in a hurry. We might take our own time and we do the core of this platform, right? And then look for that.
Okay. No, I'm asking you because your capital consumption has been a bit significant, 2 percentage points reduced on CRAR, though it's still very high at 21%. Would you look to raise capital because at least the stock markets are very kind to financial stocks?
Not this year, Lata, not this year, because we already raised some good amount of money last August. So not this year,
Mr. Agarwal, just to kind of circle back to the point on margins. So what are we looking at, sir, for FY24, if you can put a number to it? And also on some of the other parameters like loan growth, what should we expect in FY24?
So, Prashant, I would say that we want to repeat the last year performance and we really want to remain very cautious because I'm in the industry for the last 28 years, and at good times, certain time you make mistakes, right? So we want to have 3-4 clear-cut strategy which says that deposit-led growth. So we really want to grow our deposit in the range of 25 to 28%, right? And then we really want to grow our asset in the same range. We want to have our profit growing by at least 25%, right? And I think this is the larger things, but I think in terms of content, we really want to operationalize our ED1 license. We really want to stitch our digital bank again. We really want to have one more vertical in the bank, which is for rural and impact banking, right? So I think these are some other content where we are working on because generally we discuss only about deposit, asset, name on this course, but I think there are so much of other content also in a bank, and we are very new on the system, right? So
absolutely. Just so a 25 to 28% growth in deposits and advances. You said you'd like to maintain margins around the last year levels. That you were just under 6% last year. So
so there would be some leverage, and I would say you say NIM. I would say in the range of 5.5 to 5.7. We want to target it, but I think the other income can play a very important role this year. So we might have similar level of ROE and, of course, the profit growth.
Oh, other income in what sense will give you more money?
So I strongly believe that insurance income has got rationalized, that will be the one uptake. Then we will operationalize our ED1 license. We are now close to 4 million customers. We will cross-sell them more. Our productivity will go up because we are not hiring too much nowadays, So I think all put together, I strongly believe that we should do the same return ratios like last year.
Okay. Oh, that's good to hear. Ultimately, that's what investors want. Thank you very much.
It's very long-term journey, right? So,
of course,
quarter to quarter doesn't have any meaning for me, to be honest, because I strongly believe.
That would be true. That would be true of all corporates. Sanjay. But the law of the land requires a quarter-on-quarter result reportage. Yes. Thank you very much, indeed, for joining us and all the very best.
Thank you. It's always fun talking to you.
Okay.
Thank you.
All right, so the quarterly result, of course, did show both on asset quality and on margins a bit of a hiccup, and that's what the market is reacting to. We take a quick break, and we're going to be joined by the RBL Bank Management. Subramanya Kumar, Managing Director and CEO, will be with us. Welcome back. It was a bank results weekend, as you know, and one of the banks that's got a very positive response from the markets is RBL Bank. Posted an all-round positive performance in the first quarter. Advances and deposit growth, asset quality, return ratios, whatever you want, was better than what it was a quarter ago, and some of them even a year ago. Well, we can crib about margins, but the market clearly is giving a thumbs up as of now. Joining us now is R. Subramanya Kumar, Managing Director and CEO of RBL Bank. Good morning, Mr. Kumar. Thank you very much indeed for joining us. Well, let me start with the one thing about which we will express a disappointment and then come to the positives. The margins are down, not much, 17 basis points compared to last quarter, and still significantly up compared to a year ago. Will you be able to stabilize at 4.8% levels?
Yeah, absolutely, Lata. If you look at it, it is mainly because of the deposits repricing, the mergerly which has been taken place right now. If you look at the majority of the repricing has already taken place, going forward, maybe a very small repricing would like to take place in Q2. But this is going to be offset with the advances which we have already done. Our current margin will keep inching up by 10 bips by next quarter. Thereafter, it will catch up with 5%. And on average, we will exit with around 5%. And thereafter, it is going to be a positive quarter on quarter.
Okay. Let me come to the more longer-term question. What are you doing different? RBL, until recently, was run by, well, almost you can say founder, though, of course, it was an old bank, Ratnakar. It was run by Mr. Ahuja. What have you changed in terms of running the bank?
So the major change what we have brought out is the strategically driven by the board and execution by the management team. The one big change which I brought about was that looking inward with regard to the capabilities of the organization. And I should definitely give a credit to the entire team. The depth of knowledge and depth of execution capability is well entrenched into the organization. This is one I started reaping it. The second was the branches. We have around 520 branches and 1,100 to 1,200 BC points. So we wanted to leverage those points who were hitherto doing a single product or single product line. Now these have become a sourcing point for all my retail as well as the new products which we have launched in last 6 months. And one of the major change what we brought about was that having a lot of shelf products, we were looking at the products which are there on the shelf which can be retaining and the stickiness of the customer. Second, we have started building up a lot of products which will going to add up to my balance sheet. You would have seen the retail products which we have launched in last 6 to 8 months started scaling up so well, and they will all become profitable in 12 to 18 months. And this you can easily observe that they will unlock the overall profitability of the organization.
Okay. No, but your cost to income ratio, although, it has improved, it has fallen compared to year ago and quarter ago, is still, compared to other banks, 66.5 is high. Are you working with an internal target? If yes, what?
Yes. In fact, one of the ways we work is expenditure has to be there for an organization of this size, OPEX. And we are investing in the products and manpower and everything. Most of the investment has taken place in last 2 quarters. And there will be an incremental expenses as we move forward. So one tilting factor was that previously, we never had an interest revenue to substantiate or support this cost. Now you would have seen that we moved up from 15% NII to 21%. This NII will keep move up from 21 here on. So with the cost being more or less contained in the same level, of course the expenses will be incurred. I can't say that it's going to come down, but the cost to income ratio will start looking downwards, southwards. So the couple of points we will be bringing it down from the current level. And one of the major cost optimization efforts which we have done started showing a lot of results to us, and we will continue to optimize our investment in technology and investment in the manpower. The productivity is one of the area where you can see much more than what we have been seeing it today, which will add up to the income, and it will just optimize our cost. So we are confident that we will be in a position to bring down the cost to income ratio a couple of percentage points during this year itself. And year on year, with the income kicking up, we will be in a position to bring it down much lower.
So 60, 61, 62%, Mr. Subramania Kumar, this year?
May not be to that extent, maybe in the range of around 2-3 percentage points less than what you have been seeing it now.
Okay. Just to pick up on the earlier point, which my colleague Lata was talking about, which is what have you done differently? Now, one of the ways I'm assuming, a lot of people will judge the success, etc., is, the ability of the bank to attract fresh, top quality talent from elsewhere, and whether they're willing to come on board. The new direction that the board at RBL has now set for itself. Have you been able to do that? Anything you can tell us?
Yeah. See, as far as that the attraction is concerned, we are able to attract the talent where we require. See, for example, we have already signed up with a CFO who will be joining us in a couple of quarters. And we had a CIO who has also joined from the Barclays, with the background of the Barclays and other things. And we firmly believed about one fact. Creating an opportunity for the people to move up within the organization, which has panned out very well. If you look at our retail, the retail 158% is the growth in the disbursal over a period of 6 to 8 months' time. It scaled very well, our housing loan and mortgage loan. And two-wheeler and four-wheeler also, we have attracted some good talent who are heading those verticals. And these, all the requirement for rolling it up is in place, and you will see that scaling up there. So where we require a talent, we were able to attract it. For example, our corporate operations center, we are headed by a very senior guy who was able to bring in a lot of efficiency improvement. And the HR, we have just provided from internal opportunity to move up, which provided us an ability. I can just give a couple of examples of how these people have scaled up. Yeah. Launching around 6 to 7 products within a period of 6 to 9 months itself shows the capability of the internal team.
Got it. I just had to squeeze in one more question. We're running out of time. Could you guide us to what your targets on return on assets, etc., are? Could you is the 1% ROA? Do we have visibility, and by when, according to you?
See, the quarter-on-quarter, henceforth, we will not go below 1%. You would have seen that we promised that in our last call also. We will be clocking 1.1% continuously every quarter. Today, we have closed with 1.01. Going forward, we'll maintain it in a couple of quarters. And the last 2 quarters, we'll see the uptick in this. And most likely, we will exit with around 1.2, another 20% growth in this particular ROE.
So 1% with upside, basically.
Yeah, 1% with upside.
Got it.
Yes.
Got it. We'll leave it there, Mr. Subramanian Kumar. We're out of time, but thank you so much for joining us. Very confident sounding RBL Bank management with plans for the medium to long term. The bank seems to be on a strong wicket in terms of mend of its balance sheet. We'll take a very quick break here. On the other side, our special segment, Market Masters. Lata will get chatting with Ramdev Agarwal of Motilal Oswal Financial Services to get a sense of what he's making of where the market is, where it is headed. Stay tuned for that conversation.